Hello and welcome back to the Market Lens. I'm Sam Rozzi and I'm joined by Cliff Walsh, American Portfolio's Chief Investment Officer. You can check out our previous episodes in the Studio 454 video library or on YouTube. Let's jump right into our News or Noise segment. Fed Reserve Chairman Jerome Powell recently stated that they could ease up on interest rates sooner than anticipated. Do you think this is news or noise?
I think it's noise. I mean, the market's already been moving in that direction. Peak rate expectations are behind us. And if you've been following the Market Lens, this has been our base case since the beginning. We think the economy will roll over sharply, taking inflation off the table as a significant concern.
Correct. We've been saying this for quite a while now. At what point do we think Powell actually executes these ideas?
I think the Fed will raise again in September and maybe again in November, and then I think they might be done. The rate at which they've raised rates so far has been very aggressive. However, as you know, the Fed is very backward looking, so by the time their actions show up in the data, it's 6-8 months down the road. So that could mean another hike in November, even if the underlying economy is heading toward a harder landing.
Yep, so what if we're wrong? What could cause the Fed to continue hiking into 2023?
I think employment, the July numbers were stronger than expected on the surface, and wage growth has perked up. We have labor shortages in some industries, which could help keep the employment market healthier than it normally would be. That being said, a look under the hood suggests the labor market isn't as strong as it looks, but a misinterpretation of the data could keep the Fed hawkish.
Yeah, that's interesting because it's right in line with our next topic. There's been a lot of discussion of whether or not the U.S. is in a recession. President Biden's administration has pushed back against it, stating that the jobs market is still strong. I think that it's time we zoom in on the unemployment market here and see how it ties into our definition of recession.
Let's do it.
Yep. So is the Biden administration correct in stating that 2 contractionary quarters does not make a recession?
The National Bureau of Economic Research is in charge of calling the U.S. recessions, and it takes into consideration a lot of different metrics. They define a recession as a significant decline in activity spread across the economy, lasting more than a few months, visible in industrial production, employment, real income, and wholesale retail trade. So while the Biden administration is correct in stating that 2 consecutive quarters of GDP contraction does not mean we're in a recession, the fact of the matter is, in the past 75 years, every time GDP has contracted 2 quarters in a row, the NBER has declared a recession. The leading data we're seeing and the sentiment indicators have me feeling like we're in a recession right now. And with the Fed likely raising another 50 to maybe 150 basis points more, we haven't seen the worst of it yet.
Yeah, so the NBER won't call the recession before the rest of us already know it, at least based on history. So if we're left to our own devices, could the Biden administration be right? Could this be different because of the strength of the labor market here?
It's possible, but I think it's unlikely. Based on the consumer and business sentiment info and knowing the lag time of Fed actions, unemployment should rise. But let's go deeper than these soft measures. We just had the July employment numbers. They showed an additional 500,000 plus new jobs, double the consensus expectation. Fabulous, right? But when we start to compare different reports and understand how they differ, it gets interesting.
Yeah, that's interesting because equities rallied and Treasuries sold off on the news. What are you seeing that suggests that things are not that strong?
I think the biggest thing so far is the difference between the establishment survey, which showed the huge growth, and the household survey, which shows a broader look. The household survey has been stagnant since March, and the establishment survey has risen dramatically, showing 1.7 million jobs added, while the household survey shows a loss of 170,000 jobs from March to July.
Wow, that's a huge divergence. Why would that happen? It's not different sources, right? They're both put out by the BLS.
The establishment survey shows a person's second job as a new job, while the household survey does not. So what we're seeing, unfortunately, is fewer people working, as shown in the household survey, and more people getting a second job, likely to keep up with inflation, which is making the establishment survey seem strong, when in reality it's more about survival in this difficult environment.
Yeah, so how do we tie this back into the investing world?
Don't believe the hype. I think the economy is much closer to a recession than the jobs market suggests. If not, we're already in one, and this could create a situation where the Fed raises too far if they haven't already, because they think the labor market is stronger than it is. I still think risk assets are at risk. I don't believe the bottom is in, as many have been saying.
Thanks, Cliff. And thank you to everyone who's tuned in here. We hope this is letting you see 2020. Take care.